Hi, and welcome to the August Buy-to-Let Mortgage Market Update. My name is Richard Purnell. I'm from the Mortgage Home, and we are your buy-to-let mortgage specialists. If you've been looking for the July mortgage update, that was my holiday period, so there wasn't one, so stop looking. But I'm back now, back at the coalface. As usual, I'm going to start this section with interest rates and my commentary and observation on what's going on within the market. We're recording this on let's have a look, the 9th of August, and it was last week. I think it was the 3rd of August that the Bank of England met, and as widely predicted, they increased the Bank of England rate yet again, the 14th consecutive increase to 5.25%. It went up by 0.25%. As I said, widely predicted. So for us as landlords, that is really good news, because what the markets and therefore the lenders don't want are surprises. So the fact that this was completely predicted by the whole financial community, then when we look at mortgage rates didn't change. I've mentioned this a few times in the past about the difference between the Bank of England interest rate and mortgage rates, and there's a disconnect between the two. So not only are mortgage rates really stable right now, over the last 2 to 3 weeks, I've actually noticed a slight reduction in mortgage rates. Now, before we all get excited about this potential saving on mortgage rates, I'm really talking about a fraction, about a 0.1, 0.2% reduction on rates. But that just goes to show the disconnect between mortgage rates and the Bank of England rate. So we're talking about new products here. We're talking about new borrowing here, not about your existing borrowing. So if you're looking to buy a property or refinance, then mortgage rates have not really changed. And if anything, they're just dropping a fraction. The exception is those people who are on standard variable rate, SVR. So that might be a normal lender's variable rate, or it might be a tracker rate. And I took a look and I was astounded. Apparently in the UK, we've got up to 1.5 million mortgage holders on SVR. And that really surprised me, given the trend. As I said, 14 rate rises, mortgage rates from last September to now probably doubled, that more people have not come off SVR and locked into particular deals. But yet, apparently, we've still got 1.5 million people. I'd really be keen to know from our watchers why you're still on SVR. If you're happy to just put some commentary underneath as to what that is it through choice? Or do you feel you've got no choice whatsoever? Are you some sort of mortgage prisoner that means you got to stay on SVR? I'd be really interested to know. So please put something in the comments, and I shall read them as they come through. One thing I did think of are those category of people on SVR who are thinking, well, I'm looking to sell my property. We know that the market's extremely flat. If anything, it's contracting fractionally. Only a couple of days ago, I believe, the Halifax did their monthly property market update, and the annual figure for property prices have dropped 2.4% nationally. So not significant, but it's a contraction, a reduction in property values across the UK. And obviously there's regional shifts within that. So it might be that you are just sitting on your hands until the market turns and you might want to sell it, when it comes to more of a peak. However, in the meantime, you are getting these letters dropping on your doormat saying, here we go, here's another rate rise, your mortgage payments are going up yet again, and you're feeling you've got to take that hit in the short term. Well, I took a look yesterday, and there's a real significant number of products with no redemption penalties. So it might be that you guys that are on SVR want to just engage with your mortgage broker and ask about products that you could get you off a high SVR rate onto a lower, even fixed rate. There are some fixed rate mortgages out there with no penalties. There's discounted variable rates with no penalties. And therefore, is it worth moving across? Now, this is my own personal view, but it's 50-50 really, I think, about whether rates are going to go up any further. I don't think mortgage rates are going to go up at all, by the way. But the Bank of England rate might go up at possibly another 0.25%. It would not surprise me if we've now seen the last rate rise at all. I'm a little torn between a possibly a 0.25% rate rise in September. But if inflation continues to drop at the pace that it's at right now, the committee might actually leave rates alone. So for you guys on SVR, you may have topped out. So taking a discounted variable rate might really be a good shout right now. And like I say, if there's no redemption penalties, then if that saves you some money in the short term, it's an option. So if I've said anything that resonates with you guys, if you want to understand a little bit more about it, if you want to talk to the team about your circumstances and seeing whether you can save money, then there will be a link to our online diary at the end of this video. Copy and paste it, book some time in, no cost, no commitment. We'll have a chat and we'll give you some impartial advice on your situation. This video, I want to talk about capital allowances. Now, I've mentioned it a few times in the past, but only really briefly and in passing. Today, I want to put the spotlight on capital allowances. Look, as landlords, we want to save money anytime, don't we? But right now in 2023, I know that we're hurting. I know that our profits have been absolutely shot to bits. So if there's any opportunity to save some money, keep more of that rent that you're earning in your pocket, then you want to know about it. So if you don't really know about capital allowances, well, this is an important section for you. I really want you to write down some of the comments that I'm going to be making in this next piece. Now, what is it? It's a tax relief on eligible plant and machinery. Now, hold on here. I know you're going to say, what on earth? Plant and machinery? It's not commercial. It's not industrial. Bear with me. The aim is that it lowers your profits. It artificially lowers your profits from your land and property, and therefore will lower your tax bill. Now, the context is that I'm talking to you if you either are thinking of buying a serviced accommodation or a holiday let property, or here's the thing, what if you already own a normal buy-to-let, I'm going to call it, a long-term family-let property, but there's a possibility that it might lend itself to being a service accommodation holder? Is it in the right part of town, the right part of the country, that it might actually be repurposed as an SA or a HL property? Because this is yet another reason why you should consider doing that. Now, what is eligible plant and machinery when we're talking about a service accommodation or a holiday let type property? Well, here's a few examples. The HMRC says that this could be sinks, taps, showers, bathroom, lino, that's a 1980s word, isn't it? Floor coverings, carpets, door furniture, plumbing, wiring, all the electricals, the pipe work in the property that's already there, not stuff you're going to buy in the future. It's already there as you're buying the property. Then that can be converted into an allowance and therefore used to reduce your profit, reduce your tax bill. What's the process? Well, you can't just come up with it. It's not your accountant's job. They're not allowed to come up with a figure. You have to engage with a specialist type of surveyor. And they come along to that property and they do that assessment and they calculate what the plant and machinery is, convert that into a figure, that goes into a report, and therefore you can, when HMRC come calling, wave this report to them and say, this is how I came up with the allowance that I can then reduce the tax bill. Now, Here's not just a case study, not just an example. This is one of my properties that I did exactly this with. And I want to talk you through it right now. So I purchased a 3-bed cottage. Now, originally, I bought it as a buy-to-let. I didn't buy it as a holiday let or service accommodation. I had long-term tenants in it on the normal 6 months process. And then over time, I decided to repurpose it as a small holiday. I mean, there's some workers in there, there's some tourists in there. It's a bit mixture of both, but essentially going to use it as holiday let. Now here's the thing. When you are thinking of buying a property to use for this purpose, the capital allowance can only ever be claimed once. So if the previous owners have ever claimed this capital allowance on the items that I described a little earlier, you cannot claim it when you become the new owner. It's linked to the property, not the owner. So it can only ever be claimed once. So it's really, really important you get some confirmation whether the previous owners ever claimed that capital allowance. Now, in my context, this had only ever been used as a family home. It had never, ever been used by an investor or used by a landlord for any sort of rental purposes. So we got confirmation of that, and therefore we knew that we could claim the capital allowance on it for the very first time. Now, I bought this for 158k. The surveyor came along, did their work, converted it into a number, and their number, the allowance, was £38,886, which was roughly 25% of the purchase price. Now, my average profit as a holiday let, this is profit, not turnover, is about £12,000 a year. Now, it's held within a limited company, so I will be paying corporation tax of currently 19% on that 12k. However, now I've got this report with a figure of 38,886 in it. I've got over 3 years of profits I can make tax-free. Because every time I make £12,000 of profit, I take £12,000 off the 38,886, and the 12,000 profit reduces to nil, no tax pay. And now I don't have 38,886 left. I've got 26,886 available for the next year. I deduct another 12k off, that drops to 14,886, and so on and so on. So come year 4, I would have what, 12, 24, 36, £2,886 allowance left to offset against my profits right into year 4. So I've got all these profits that I can now keep every single penny on. And if we turn that into real pound notes, at 19%, that would save me £7,388. Anybody want £7,388? Yep, absolutely. So it's exactly what I did, and that's exactly what I'm doing, and that's why I want to share that potential good news with you guys. So, one final comment. This is tax advice. Although I am a chartered accountant, I'm not a practicing accountant. I cannot give you advice. So this should not be treated as tax advice. You need to make your own inquiries. Speak to your own accountant about this. Oh, and by the way, I know quite a number of clients have come back and said their accountant has never heard of this allowance before and may even want to dismiss it. Now, I'm absolutely telling you that this is a HMRC acceptable allowance in the right context. It might be that you're with an accountant that is not a specialist within the property tax arena. Just want to plant that seed. Are you with the right accountant if they're coming back and saying, I don't know about this, or they've never tapped you on the shoulder and said, you know, you can claim this if you already own a holiday let or a service accommodation property? Then have you got the right professionals surrounding you and advising you? That's a bit of an aside, but I think it's important to say. So if you want to know more about this, I have an information leaflet on it. So underneath this video in the comments, I'm going to put a link in there. So just click on it and download the information leaflet. It'll give you some more information. Hopefully it's going to have some real value. Hopefully there's going to be that pot of money that you can save, whether it's on your existing portfolio that you already have as holiday lets and SAs, or as I said, have a think about your portfolio and whether is this the extra element that's going to make it viable to move away from being long-term lets to short-term letting, because this extra allowance actually makes it financially viable for you to do so. So I'm hoping that's been of use to you. As I say, click the link and download the information, and I really hope that's of use to you. In this piece, I want to talk about investor deposits. Now, I've talked about this a couple of times in the last 6 months. A really exciting innovation that is going to allow us to sidestep a really restrictive policy that the majority of lenders have when it comes to the source of funds for deposits. Let me just rewind a little bit for those that don't know what I'm talking about. So if you're looking to purchase a buy-to-let, indeed any property, but in this context, we're talking about buy-to-lets, lenders have some really strict rules on where the deposit is allowed to come from. If it's your own funds, of course, that's absolutely fine, though you have to prove it. You've got to prove the audit trail that it is your own funds, that no third parties secretly squirreling the money in your account the day before or the week before. You've got to demonstrate it's your funds. That's perfectly acceptable. That's the norm. What's also acceptable is if your family feel generous enough to give you the deposit towards the purchase. Tends to be blood relatives that's acceptable, but either way, it's family tends to be okay and ticks the box from a lender point of view. Now, what happens when an investor, and a lot of our clients look to work with investors to allow them to purchase their properties at a pace that allows them to achieve their financial goals? Well, generally speaking, lenders will only allow an investor to bring the deposit into the mix if that investor becomes a party to the mortgage and the ownership of that property, or if the property has been bought in a limited company, and a shareholder within the limited company. Now, if the investor says, yeah, I'm quite relaxed about that, fine, but many investors don't want to get embroiled in that. They want to stay at arm's length. Or indeed, you don't want them to be a shareholder in that limited company, in that SPV. You want to keep them, in the background. So that's the issue. That's the nugget that we've been trying to unpick. And we've now got a strategy that we've road tested this year. And we've had 2 bridging cases, purchases, and 2 what I would call normal long-term mortgage purchases accepted by lenders on this new scenario. So really exciting that the lenders, the underwriters, have given it a thumbs up and signed it off. So we feel more confident now to say it looks like we've got a workable solution here. And in some of these cases, the investors were putting in 100% of the funding. As I said, the investor has no actual relationship to the buyers. They're not family members. Literally, they've come together purely for the purposes of the investor loaning money to the buyer, and the buyer then buying the investment property. The loan can be paid to the individual who's buying it, or indeed into the limited company that's buying it. Either way, we've road tested both. So really exciting. If that's something that is part of your strategy, are you looking to work with investors to achieve your objectives that little bit quicker and want to know what all the options are? Then again, there will be a link at the end of this piece. Copy and paste it, write it down, jump on that. It'll take you through to our online diary, book some time with the team. They'll explain it in a bit more detail. See if you're eligible for this process, and then that could really open doors and accelerate your progress to getting you to the portfolio level that you need to be at. So really exciting stuff. So hopefully, again, that's of interest to you. And like I say, click on the link to our diary to understand this a little bit more. In this section, I want to talk about offset mortgages. Look, as landlords, we want to be saving money at any time. In 2023, we are really struggling. I know that lots of landlords are struggling to make profits, retain the income that they're earning from their tenants. So any opportunity to earn even more money or keep more of that money that you're earning, I want to share with you. And although a lot of people might know about offsets, that they've been around for 20 years or more, they've certainly gone off the boil more recently. So I want to bring it front and center because it may be something that's relevant for some of our watchers today. So for the minority that don't really know what an offset is, you're a little unclear, let me just talk you through how it works. So as an example, an offset mortgage in its simplest form has got two pots, two buckets. Bucket number one is the mortgage bucket. So that's with your mortgage in it. Let's say you owe £90,000 on your mortgage. Then we've got a second bucket, which is your savings bucket. And let's say that's got £20,000 in it. So here's the thing. The computers behind the scenes recognize that the two are connected, and every day look at the balance on these two buckets. 90 grand of mortgage, 20k of savings. So rather than charging you interest on £90,000, you don't earn any money, but the 20,000 essentially is netted off. No money moves. The money stays in the individual buckets, but you're only charged on the net amount. So you're only charged interest on 90 minus 20, £70,000. So in essence, your money is working harder for you. Your savings are working harder for you, and you're paying less interest. Now, with the buy-to-let offsets that are out there, the typical rates, I put them on this screen, are less than 6.5%. So middle of the road interest rate, I would say, for a buy-to-let. Now, a few restrictions, just so that you know. So you might want to write these down. If you own that buy-to-let in a limited company, you can't get this offset mortgage. It's only for mortgages that are owned in personal name. The properties themselves need to be either long-term buy-to-lets or multi-unit blocks. Not HMOs, but multi-unit blocks where you might have 2, 3, 4 flats, 4 units within a block, and it's all on one freehold title. That's the definition. So it needs to be one of these types of properties. There's only one linked savings account. So again, it's the simplest form of an offset. One savings account, one mortgage, two are linked. Unfortunately, for this product, not available in Scotland. It's an England and Wales thing right now, but we are monitoring this as we go. What I'd like to do is give you an actual example now to demonstrate the savings that you can make on this. So again, you might want to jot these numbers down so you can keep them, or take a screenshot of it. So let's say you had £80,000 mortgage. Now, I've put here a figure of 32,000. Now, straight away you might go, oh, wow, if only there was £32,000 of cash flow in my property account. I don't have that sort of funds that, it's my working capital for my properties that I use for repairs and ultimately paying tax bills and so on and so forth. But I want you to just think a little wider than just the cash flow that you use for your property account. Do you have savings in other savings accounts, deposit accounts, ISAs? Because even though I'm not an investment advisor, and you should not treat this piece as investment advice. I cannot give you advice in this area, but I do want to sow some seeds. I want to get you thinking more than just the savings or the cash flow you have in your property rental account, for example. Because here's the thing. How much are you actually earning in interest on your notice accounts, on your deposit accounts, on your ISAs? Is it 2? Is it 3? Maybe you're getting 4% on your ISA. But if the headline mortgage interest rate is 6.34, then any money you have in that savings account, even a pound you have in that savings account, is working for you. Important point. It's not earning you any money, but it's working for you at a rate of 6.34%. So in my mind, in simple terms, any savings you've got in these other pots, if you have them, if you're lucky enough, or you've been able to save money up in these other pots, it has to be earning you at least 6.34% to say, no, I'll leave that money alone. And in fact, you would argue, because you pay tax on interest earned. So in essence, you've got to be earning probably 8% gross to then keep the net of 6.5% to be comparable with this example. So are your savings earning you upwards of 8% to say I should be leaving it alone? If it's considerably lower than that, then there's an argument to say, well, why don't I pull it all together and put it in this offset account and have it work for me at 6.34? So bear with me, if we had this £32,000 of savings, then once you've netted that off the 80k, it's as if you had a mortgage interest rate in this example of 3.8%. Who wouldn't want a mortgage rate? Hey, times change, don't they? 3.8% a year ago was, we'd take it or leave it. Now we would grab it with both hands, wouldn't we? So that's the power of the offset mortgage. So if I've said anything on this piece that resonates, that piques your interest, that says, oh, well, it might be something that would be useful for me. If it means I get to reduce the mortgage interest and therefore save more of that hard-earned rental that I'm getting in, then it's worth looking at a little bit more. And of course, it's down to each individual. You got to look into the detail. But look, there's a link to our online diary at the end of this piece. So copy and paste it. Book some time in with the team. They'll talk you through how offsets work in more detail. They'll talk about whether you'll be eligible for these mortgages. And listen, let's widen that conversation. I'm talking about buy-to-lets here because obviously this is aimed at landlords, but there are offset mortgages on the residential side as well. So again, is it worth having a look at your residential mortgage and saying, is now the right time to look at an offset mortgage, given that the way that times are, and we're all looking to save money more than ever. So I hope that's been of use to you. Click on the link to take you through to our online diary, or copy and paste it, type it into your browser, book some time in with the team, and we'd be delighted to see if we can help. In this piece, I want to talk about critical illness cover, but it's for the 21st century. Now, first of all, I want to talk about traditional, the old type of critical illness cover, which I did not like very much, and many of our customers didn't like too much either. And I'll describe why, and then I'm going to move on to this new 21st century type of critical illness cover. So traditionally, it's been around for about 40 years as critical illness. And generally speaking, there's up to about 40 conditions that are listed within this policy. Now, importantly, you're not going to die. If you're going to die, then life insurance is the policy that you want and that you would be claiming on. So it means that you're going to survive one of these hideous conditions. Now, I said that traditionally there's about 40. Within that, there's three main conditions that by a country mile take up something like 80 or 90% of all claims, and that's heart attack, stroke, and cancer. So let's say you had a heart attack. You've not died, otherwise the life cover policy would be the relevant policy to claim on. You've survived it, but clearly it's been a real trauma, been a lot of upset, upheaval. Maybe you've been off work for a while. Maybe you've got to change your job, or you've got you've gone to light duties, or perhaps you've got to adapt the house in some way. There's been some real impact. However, here's the thing. Behind the scenes of this headline label of heart attack is a very strict definition, a written explicit definition of what the insurer says is the acceptable severity for the heart attack. And they look at your claim and put it alongside it, and it either is at the right severity or it isn't. So in other words, you either will be able to claim or you won't. It's black and it's white. It's as simple as that. So let's say you had a £200,000 cover for critical illness. You're either going to get £200,000 or zero, nothing. Go away. Don't darken our doorstep because you weren't eligible. And it's really blunt instrument in that way. And that's what I really don't like about it. So what I really love about these new modern is that they're just fairer. Not only is there 174 conditions, there's a list as long as your arm in terms of the conditions. What's more importantly, let's stick to this example of the heart attack. The more modern providers of this type of cover have not one, but 4 levels of definition of what a heart attack is, from the minor, if there's such a thing, heart attack, right up to the severe heart attack. So when you put your claim in, they compare it to all the definitions. And if it's at the severe end, you'll get your 100% payout. There you go. There's your £200,000. You know, get on with your life, sort out, you know, your job situation, your home, whatever turmoil has gone on as a result of that heart attack. Or it might be, oh, well, actually, it was only like a warning type heart attack. Yeah, you were off for a little while, but actually there's been no real impacts, you know, significantly, and you've been able to go back to work, however. But and so it's right at the lower end. So, okay, you've hit the 25% one. So there's a 100% payout, a 75%, a 50, 25%. So it might be you therefore get paid out £50,000, the 25% of the cover amount. So you still get something commensurate with the level of severity. Seems a little fairer. On top of this, if you had a pot of £200,000 of cover and you claimed 25%, so 50k payout, there's still 150k in the kitty. So if you really had bad luck and there's yet another claim in the future, heart attack or any other of the 173 further conditions, then you can still put another claim in and get a payout on, you know, if something hideous has happened to you in the future. Really, I really like this policy. It just feels right and fair and balanced. Now, here's the thing that the insurers are doing, because they clearly recognize from a pure commercial point of view that what type of customer do we want? Well, we really want those that are fit and healthy to start with, because they're less likely to claim. They're less likely to have a heart attack. They're less likely to have a stroke or some of the other conditions. So how do we attract customers who are either already in a routine of exercise and keeping fit, or we incentivize them to get into those good habits? And so what the insurer does is, in the way that Fitbits and, like I'm wearing a Garmin watch, you can sync to an app. Then the insurer provides an app and you can sync to that and it uploads that data. So the insurer says, right, we can see that you're doing some swimming, cycling, running, whatever it happens to be, whatever exercise it is. We convert that data into points. The points then convert into reduced premiums. So if there's going to be a less numbers of claims, some of that saving is passed on to you in cheaper premiums. Again, just seems fairer, doesn't it? And the final thing, if you're into these things, they also dangle a few shiny little carrots, and they'll offer you free cinema tickets, free coffees. I think it's a Cafe Nero, reduced price on tech, gym memberships, considerably cheaper, that sort of stuff as well. There's a whole list of either free or highly discounted items for those that want the extra bonuses there. So really love this product. Reasonably new on the market. So again, if it's something, have you been thinking of critical illness policy? You know, normally it's a trigger. You don't wake up in the morning thinking, oh, I must have critical illness today, but sometimes something's happened. It could be a family member that's had a scare. or sadly been diagnosed with a cancer, and you think, wow, okay, we're not going to live forever. You know, we are just mortals here, and we are susceptible to these things happening, and it can turn your life upside down. So does it make you think? Maybe you've already got a critical illness policy. Maybe it's one of the traditional ones that I've just described. And is it worth moving to one of these new types of critical illness policy? Then look, at the end of this video, there is a link to our online diary. So click the link, book on there. There's two options, one for mortgages, one for insurance. So click on the insurance one, speak to our insurance team, and they'll give you a lot more information on this. See whether it's something that might be suitable for you. I'll give you some quotations, no commitment, and you need to be further informed to see if it's something that is relevant for you. And just to finish off, as I said earlier, this is our ways that you can get in contact with us. Right at the top, the link to our online diary. If you do want to ring the office, then there's the number, 01756 699 600. Give us a call and book a time with the team there. We'd be delighted to have a chat about anything that we've discussed today. Link it to your personal situation and see if we can help you along the way. Thank you so much for watching this video today. I hope you have a great month, and we'll see you on the next update.